at Rev Equity Group, these weekly webinars are strictly educational. We don't solicit any deals. We don't solicit any opportunities. We do these webinars on a weekly basis so people can learn and understand that there's other options out there. And what we focus on specifically is multifamily investing or apartment investing through the process of syndications and funds. So these webinars and education are geared to those looking to passively invest. But even if this is something you're looking to actively get involved in, the information is applicable just the same. So appreciate you being here. We do record these and we upload them to our YouTube channel. So if you want to go back and listen to them or see them, we'll bring in guest speakers on different topics. You'll always have access to those. So if you have questions, go ahead and throw them in the chat box. That way we can make sure that we answer them. And previously what we've done our webinars, and that's a lot of me talking, and I don't even like hearing my voice that long. So what we've decided to do, and just to try to promote and help get more people on, is condense them down. So we're actually our weekly webinars are gonna be condensed down to 30 minutes so we can be more focused on a few topics. And then if we do want to go a little over, that's fine because we can open it up for more Q&A. So it really depends on who the speaker is, what the topic is, but that's going to be our structure, is 30 minutes of education content. If you have questions along the way, put them in the chat box and my team will bring them up when applicable. We are streaming on a few other platforms as well on social media. And really the purpose is to get this information out there. So see some new faces today. Appreciate you being here. So what we're going to talk about today is the acquisition process. Now, we're not going to be able to get into the nitty gritty, but for those that have passively invested in deals before, you often won't see the opportunity until it's in your email or until somebody calls you. And so it's not uncommon to not understand or not be aware everything that goes into acquiring these deals before it's even presented to you. So for today's webinar, I just wanted to talk about some of those things because as passive investors and operators, as they understand and are on the same page with things, it creates a much more fluid relationship and partnership. So we're going to be talking a little bit about the acquisition process. And the first thing you've got to do, right? You can't get a deal done if you don't have the deal itself. So sourcing the deal, this actually requires a lot of work, patience, and consistency to it. Because once you start getting into the larger apartment acquisitions, and when I say larger, I'm talking 40, 50, 60 units or higher, almost all of those transactions are done through brokers. A broker's entire job, what they do all day, every day, is connect with buyers and sellers. That's what they do. So when people are looking to invest and buy these deals, their strength or specialty might be in some other industry. And so they connect with brokers to help them find these deals, whether it's to buy or to sell. And so more specifically, this is what they refer to as broker relations. Now, that in itself takes time. You can't just walk into a broker's office, introduce yourself, and say, I want to buy a property, and expect them to give you their top listing. They don't know you. They don't know you. They don't know anything about you. If you're new, if you don't have a track record, they're going to sit down. They're going to want to talk to you. So broker relations, it takes time. You've also got to have the track record. Now, when I say track record, I'm referring to, think about it, a broker, when does a broker get paid? Let me ask that question, right? A broker gets paid when that deal closes. whether they're on the buying side or the selling side. Although you need to have an effective track record of operating that deal, a broker's primary focus is going to be on, can you close? Because that's when they get paid. Now, they provide a lot of tools and resources and will help along the way, but they want to see a track record of closing. So if you've never closed on a large apartment deal before, that might be kind of tough. But one thing I love about apartment investing is that you don't have to do it all on your own. You can't. There's absolutely no way. So if you partner up with a team that has a track record and they put you in charge of building relationships with the broker, that's how you get around this, because then you can leverage their experience, but it still takes time. So you got the broker relations, you got the track record in closing, and you've also got to have market knowledge. Now, we get people on this webinar from all over the country. So not sure where some of you are. Brandon, Cram, if you don't mind sharing with us, where are you based out of? Oh, I got you. You're still muted, Brandon.
Sorry about that. Can you hear me now?
Yeah, we got you.
I'm calling in from Glendale, Arizona.
Oh, dang, you're local. Do we have anyone that's not local?
Salt Lake City, Utah.
Salt Lake City? Awesome. Okay, so Justin, I don't know anything. I've been up at the Salt Lake, been to Utah a few times, but is it safe to say that there's places in Salt Lake that you would invest in and places that you wouldn't invest in neighborhood-wise?
Of course. There's a city here called West Valley City. Don't go there ever.
Okay, see that right there, that's market knowledge, right? So to source a deal, you've got to have the relationships with the brokers, you've got to have the track record, but you've got to have a knowledge of the market. And when I say knowledge of the market, not the stats that you're just seeing online for Salt Lake or for Phoenix or for Dallas or for Houston, that stuff is important. But within those markets, there's neighborhoods you don't want to go in. There's neighborhoods you don't want to go to near. So in order to effectively source a deal, you've got to know where those deals are so that when the broker says, hey, here you go, Brandon, here you go, Justin, you're aware of where that property is and that they're not tossing you a hand grenade. Brokers love the new people with money that don't know what they're doing. So have that experience, have the track record, have that team around you to source the deal. Now, it might take you, we closed on a deal with a team back in December in Houston on a deal that they were working on the broker for over 6 months, in communication with that broker on that specific deal for over 6 months. This in itself can take quite some time. It can often take six to 12 months. Any questions about sourcing the deal before I move on to the next point? Feel free to speak up or throw it in the chat box. Okay. We're going to keep going. Number 2, underwriting. I can't stress this enough. Underwriting a multifamily deal, underwriting an apartment building is so much more than just plugging and chugging numbers. Anybody can plug and chug numbers. You get the rent roll, you get the T12, you get the offering memorandum from the broker, you throw it in a spreadsheet and it spits out what that deal is going to look like. Anybody can do that. That's not difficult. The difficult thing with underwriting is interpreting the numbers. What's the story behind the numbers? And what are the trends? When certain numbers are doing certain things, what red flags does that trigger for you to want to look into and to ask the broker or ask the seller certain questions? Underwriting, somebody that's very experienced in Excel and with numbers, on average, I'd say it takes a good 9 to 12 months before they're pretty comfortable and fully understanding the underwriting model and how to interpret it. And even then, until they start putting it into play and developing that business plan and seeing how the numbers play out, there's a lot to learn. Underwriting is significant. However, I wouldn't say that it's the number one thing when looking to vet a deal. And we do another webinar on this, so I'm not going to get into it. But what we tell people all the time, if you're looking to vet a deal, there's three main things you want to look at. Number one, the operator. Vet the operator first. Number two, vet the market. And then number three, that's when you vet the deal. And the reason being is because you can have an awesome deal with a bad operator and they can run it into the ground. And then you can have an okay deal with a good operator and they can hit a home run. So always start with the operator, but underwriting is still a significant part of this. So I'm going to give you three things that you're going to want to look at. These three numbers, if you alter them just a little bit, it can make or break a deal. And these are the three that I'm going to give you right here. And we're not going to get into depth about them, but I at least want to make you aware of them. So number one is the rent growth. What have the rents been doing in that market over the last 10 years? Not the last 2 or 3 years. If you've been in Phoenix, if you've been in Salt Lake, if you've been in Dallas, Houston, for the last 5 years, those rents have been going nuts. They've been climbing like crazy. So see what the rent growth is for that market, and then do a conservative approach in your underwriting. So right now, I see people doing rent growth in year one at 0%. That's conservative, and I would say probably appropriate for what's going on in our country and in our economy right now. So typically you might see anything between 3 to 5%. If you see anybody that's up at 8, 9, 10% in year one, that's a red flag. Ask questions, especially if it's a value add play. If they're going in and doing a bunch of renovations, they've got to move tenants out to renovate those units, but yet they're still expecting a 10% overall rent increase on the income coming in. So rent growth, you want to check. Operating expenses is a big one. Now, thing to note on operating expenses, it's going to vary based on the product type you're investing in and the market that you're in. For example, in Texas, your insurance and your property taxes are going to be significantly higher than they are in Arizona and Phoenix. So what you might see in Phoenix operating at a 30, 35% expense ratio, in Texas, that similar property might be operating at a 40 to 45% expense ratio. So knowing the operating expenses for that area, for that market, are essential. And if you don't know where to start, talk to a local operations team, an investor there, talk to a property management company that's managing a similar asset, and you'll be able to find out that information. So kind of the rule of thumb I give for operating expenses, if you're looking at a deal, again, depending on the market, is 30 to 50%. That's kind of the window that you want to be in. I had a buddy of mine call me up from upstate New York and was looking at a deal, and it was the guy managed it himself and was trying to say that the operational expenses, the numbers he gave ended up being, I want to say it was like 15% of the income is what he was saying. That's all he was spending on operations. And that might be the case, but the question I asked my buddy, I said, okay, if that's all he's been spending and the numbers prove it, what has he been neglecting? What hasn't he been maintaining? That's going to be a big ticket item for you if you're to take this over. And so that's another thing to note too. If you're looking at a property that's managed by the owner, they're going to try to run that as lean as possible. So they might come in and try to tell you we're operating at a 15, 20% expense ratio, but that's not the industry norm. So still underwrite, look at it, make sure you're within that range. So rent growth, operating expenses, this is the biggest one right here. If there's one number, one thing that you want to take note on when you're reviewing underwriting on a deal, it's the reversion cap rate. Now, I'm not going to get into cap rate. A lot of you probably already know what that is. If you don't, just watch a quick YouTube video, look on Google. What I want you to understand with the cap rate is that is, as cap rates go up, prices go down. As cap rates go down, prices go up. And the market determines the cap rate. Okay. So what the reversion cap rate is let's say you're buying a property that's selling or trading at a 5% cap today. The reversion cap rate is what the team is projecting that cap rate to be on the exit. And that might be 5 years from now. So industry norm is 10 to 15 basis points per year that asset is held. And basis points, like 10 basis points is 0.1%. So if you're buying at a 5% cap, let's say that the reversion cap is 10 basis points per year for 5 years, you're going to be trading at a 5.5% cap. So again, I don't want to get too much into that, but the reversion cap rate, if they're buying it at a 5% and you look 5 years out and they're selling it at a lower cap rate than what they bought it at, red flag. Because that means they're banking on the market and they're banking on the forced appreciation. And crap can hit the fan. Nobody has any control of that. So the reversion cap rate, you always want to see that higher than what they're purchasing it at. At minimum 10 to 15 basis points per year that asset is held. Just some minor revisions in that cap rate by a few basis points can totally alter the deal. You want to make sure that there's padding on this deal so people can project what might happen. We're going to get into this in the last point here in a few minutes. But when it comes to, actually, it's this one right now. Any questions about underwriting before I jump into the next one? All right, yeah, underwriting. Any questions about what you might want to look for? Red flags, anything like that? Cool. Okay, so this one, financing, 3 things you want to look at. And again, all this stuff is typically happening before you as a passive investor even see the deal. So it can be very overwhelming. And that's, to be honest, that's kind of the point of this webinar, is to show you how much work goes into these deals before it's even presented to you. So you got to qualify for financing. There's 3 big things here. You got to determine what the best loan terms are for that business plan. You've got to have the net worth. And you've got to have the liquidity. Okay. So loan terms. Right now, this is probably one of the most important things you should be looking at when vetting a deal, is what type of loan is in place. Because what's happening is people got into these floating rate loans 2 or 3 years ago. And guess what's happening now that interest rates are skyrocketing? They can't get out of them. There was just something in the news, the Wall Street Journal, a couple days ago. Somebody in Texas foreclosed on 3,200 units, about $250 million worth of apartments, foreclosed because they were no longer able to service the debt. And I don't know what that loan structure looked like 2 or 3 years ago, but I'd imagine he was being fairly aggressive to try to get those deals, because 2 to 3 years ago, it was nuts trying to buy multifamily real estate. People were letting their money go hard, $1 to $2 million on day one. So if they didn't close on that deal, they would have lost that money. It was nuts 2 to 3 years ago. But people were still wanting to get deals done, so they were getting creative with loans and doing higher risk loans, and now they're paying for it. Now, I don't share that with you to scare you or deter you away from apartment investing, because I still wholeheartedly believe it's one of the best, most secure investments you can make, because you're providing a basic human need and you can control the value of it. But keep in mind that with these people that are foreclosing and losing out on these opportunities because of the decisions they made 2 to 3 years ago, what does that mean for us? What does it mean for those that have cash ready to go? There are going to be opportunities over the next 12 to 24 months for sure happening in the multifamily space. And at Rev, this is one of the reasons we're going the fund route. We're working with investors to have that money ready to go so that when these opportunities present, boom, we can jump on them. Because people are going to be hurting, and they already are. So financing, you want to make sure you have the appropriate loan for that business plan. And I'm not opposed to bridge or short-term debt, but make sure you purchase the rate. Cap the rate, so if interest rates go up, your interest rate doesn't go up. That will enable you to be able to sleep at night and hopefully never have to foreclose. Net worth. General rule of thumb, you've got to have a net worth equal to or greater than the loan amount. So if you're getting a $10 million loan, your team, your general partnership team's net worth has to be $10 million or more. That's typically what banks are looking at. And liquidity, generally 10% of the loan. So if you're at $10 million, they want to see that you have at least $1 million in liquidity in case crap was to hit the fan. So, man, we're coming up on time here too. I got 3 more points I wanna cruise through before I erase anything about the deal, underwriting, or financing. I want to open up to any other questions. Okay. Okay, so what else does the operations team do before you even see this? There's a lot of legality. They're talking to attorneys to structure the deals. When you get involved in this type of investing, you're involved with the SEC. And so you have a securities attorney on speed dial, he's in your favorites, and you're constantly communicating with them to make sure that your offering and what you're doing is compliant with the SEC. Because the last thing anybody wants to do is to go to jail or prison. At least I like to think that's the case with most people. You question that with some decisions some operators make. Okay, so your PPM, that's your private placement memorandum. That's your, look, listen, I don't know how else to put this. This is your 40-page document that's basically telling you every way you can lose your money. That's what that is. But it's also going to talk about the distribution structures. It's going to talk about the organization, when capital, return of capital, return on capital, what that looks like. All that information is going to be in there. Your operating agreement is how the business is going to be ran, who's managing it, partners. You've got the pitch deck. You've also have entity structure. What I mean by entity structure is in these types of deals that we do at Rev, and if you've been involved in larger apartment syndications or funds, you're purchasing shares, you're purchasing units within that company that's buying the real estate. And so there's some entity structures and some asset protection that the attorneys will help set up so that even if you're invested in this passively, you're not putting your personal assets at risk because it has these layers of protection. So that stuff is getting structured. And then I mentioned this before. This is a big one. SEC compliance. You've got to remain compliant with the SEC. So having not just knowing a good securities attorney, but having some knowledge about that yourself so you don't unintentionally do something that can get you into trouble. For example, there's certain exemptions, certain offerings that you can't advertise. You can't put on social media based on that exemption that operator is using. So if that operator was unaware and then they start publicly soliciting some of their deals to investors, they can get themselves into trouble. So you've got to have that basic understanding and knowledge. Okay. 5th point, and then there's one more after this.
Hey, Dallin, this is Beck. While you're going through some of this stuff, why don't you share with us who's doing that stuff for your Rev when because you're doing all this due diligence.
Correct. So who on our, help me better understand your question, Beck.
Yeah, who on the team is doing this work for you? Or are you contracting with a third party outhouse counsel, external counsel to get this stuff done, or are you doing it yourself, or who's doing it?
All these points that I'm talking to,
Uh-huh.
it's a little bit of both. So at Rev, we've got a team of 7 people. We go through. I'm not writing up the legal docs, right? Obviously, you have an
Right.
attorney do that. But as far as
Right.
the due diligence, as part of the vetting the operators, vetting the deal, that's what we do at Rev. And our whole thing is that we want to make apartment investing as easy for people as possible. So this is the reason I'm sharing all this stuff with you, is to help you understand what goes into it, but understand that you don't need to do all that. I think it's important that everyone, whether they're actively involved or passively involved, needs to be aware of this stuff, right? That's part of your ownership and doing your own due diligence and investing in an operator and a deal. But we do all this. We do all this at Rev so that you don't have to, but that doesn't mean you shouldn't know what we're doing. And that's really that's really the big thing about these webinars, is whether you work with us or not, or on your own, you need to know this stuff. So we pull the curtain back on everything we do. And even if somebody's passively investing with us, we still share with them everything that we do in the processes that we go through. In fact, I got a couple documents that I'm happy to share. These are free documents we give out for education. One of them is how to vet an operator. It's a 60-step process that we go through to make sure that we're partnering with the right people. I'll happily share that with you. It just gives you some guidance and some points. The other document we can share is how to read through a PPM, a private placement memorandum. As I said, this can be a 40-page document, and there's a lot of information on there. So this sheet we put together just highlights some of the key areas that you would want to draw your attention to. A lot of it is boilerplate legal jargon that can be exhausting to read through. It's still your responsibility to read through it and understand. However, this document we put together in coordination with a securities attorney highlights some of the main areas that if you just want to skim it, or if you've done a few deals with this operator and you want to know how some of the basic structure is, you can look at it there. So we've got both of those. I'll happily share them with you. Looks like somebody already requested it. So yeah, happy to share that. Okay, so capital raising. First and foremost, do not raise capital from anyone unless you've consulted with a securities attorney. Okay, I'm going to say that again. Do not raise capital from anyone. I don't care if it's your sister, your dad, family, friend. Don't raise capital from anyone unless you've consulted with a securities attorney, because a lot of people are violating securities law and they don't even know it. Okay, so make sure you have a good securities attorney on your team before you do this. Now, as far as capital raising goes, I'm going to share with you what's worked for us. Number one, education. We educate the crap out of our network, because a lot of people don't even know that this is an option, or what we do is available to them. I knew before I started getting into apartment investing, I drive by these 200, 300 unit complexes. I was like, man, how lucky would it be to be that person that owned that entire complex, or work for that big institution out of New York City that owns those 200-300 units. And that was my ignorant, naive self thinking that, until I started learning that these properties are purchased by people like us that pool our money together and invest into something a lot larger than we could do on our own. Sure, we could throw it into a single family home, but once you start looking at the benefits and the perks of investing into large apartment deals, you can't compare single family, multifamily at all. So it enables people to get in to these investments at a fraction of the cost. And so that's why we focus on education. Raising capital also takes time and it requires a network. There's a saying I've heard out there it's complete bull crap. And it's, if you find the deal, the money will come. Some of us have probably heard that before. If you find the deal, the money will come. I'm telling you, that is complete bull crap. Maybe in some unsophisticated, inexperienced investor networks, maybe if it's a smaller investment where they only need like 10, 20 grand or something like that. But when you're raising $10 million to buy something that most people don't even think they can participate in, I'm telling you, the money's not just going to come flowing in. It takes time to build that network. It takes time to build that trust. We have investors anywhere from $50,000 to $500,000 of their hard-earned capital. People don't just toss that out freely. There's steps and things that need to happen before that partnership even takes place. That takes time and it takes a network. Building your network takes time. People need to earn their trust in you. You get a few people investing with you, they have a good experience, they start referring their friends and family, and it starts compounding. That doesn't happen overnight. It takes time. And honestly, like all this stuff I'm talking about, we vet operators, we vet partners that we work with to do the management, but Rev's primary focus, this is what we do. We bridge that gap between the investor and the operator so that the investor can feel more comfortable at where their money is going. And so we provide that education. This is what we do full time. And this is just one of the few things that has to happen in order to get a deal done before most people even hear about it. Okay. Okay, last one. I'm going to touch on this real quick because we're running out of time here. It's due diligence. And what I mean by due diligence is I mean physical due diligence on the property. So you get a deal under contract. Most of us have probably bought a single family home before. You buy that home or you get it under contract, and then you have your inspection period. And you usually invite a home inspector out. They go through, they look at everything. They say, hey, there's some shingles missing and these outlets aren't working. It's the same thing with multifamily, but instead of one unit, you might be doing 200 units. So this physical due diligence, usually you have a team that comes with you and they go into every unit. And I wouldn't say it's as thorough as a home inspection for your personal residence, but they look at all the major things. They look at the plumbing, they look at the roofs, they look at the condition of the units. And this is so important because what the broker is going to present to you when they're selling this property, it's going to be the one unit that they renovated that looks super sexy, right? That's going to be the one unit that they put and advertise on their marketing material. But when you get there, you realize, hey, half these units are completely vacant. Nobody's living in them. They're trashed, whatever the case may be. You need to do that physical due diligence. You need to get on there. You need to see what the neighborhood looks like around you, the market that it's in. You got to check the plumbing lines. You got to check the roofs. You got to check the HVAC, air conditioning. Do they have separate units? Is it master metered for water? Is it individually metered? There is so much information that goes into this due diligence. And again, you have a team, but you've got to have boots on the ground to really dive in and see what's happening at that deal and on that property. And part of that too is also vetting the property management company. Do you want to keep them on? Do you want to bring on a new property manager? Ton of information, ton of stuff that has to happen before most people even see the deal. And honestly, I scratched the surface on this for the sake of time, but my hope is that you at least were introduced or have a more clear idea of certain things to ask, certain things to look for when you're presented with an opportunity. And if nothing else, just understand what goes into the deal. And honestly, this is the easy part. All this stuff I shared is the easy part, because then once you close on that deal, Now you've got to put all of this to work. You've got to implement all of this. So with that being said, that's what I wanted to cover today. Just again, review some aspects of the acquisition process. I see a lot of people asking for the documents. What I can do is go ahead and throw that in the chat box. Hillary or Jim, I don't know if I gave you copies of that, but I'm happy. I blocked out till 11 o'clock. We've got a few minutes. If you guys have questions, I'm happy to have a little Q&A right now on anything that we talked about, or maybe it's something we didn't talk about. I'm happy to be a resource to you.
So Dallin, Hillary's already offered to send the documents out to everybody's email that's on the webinar right now. So I think we've got that covered.
Okay.
There was a question from Anthony. I did answer it, but if we want to talk about it more so everybody else sees it, Anthony said, did you say raising private money applies to single family as well with the SEC? I answered that as raising private money for any type of investing is regulated by the SEC. If you are raising money with the expectation of offering a return to investors without their involvement in the deal, then yes, you need to involve an attorney. So guys, raising private money, if you're raising money from anyone at all who is going to be passive in a deal, and it doesn't matter if you're doing multifamily, single family, self-storage, if you're trying to raise money for going and buying a diamond mine, or it doesn't matter what you're raising the money for or what you plan on using it for. If you're raising it from passive investors, you need to get an attorney involved because you will be regulated by the SEC, right? Because you're basically selling a security no matter what the asset is on the other side.
And Anthony, great question. And honestly, like anytime those questions come up, we always default to consult with a securities attorney because that's honestly the best thing you can do. Now, we don't have a lot of experience in the single family space either. I know some people will secure the loans, that they might be like first position or lien on the property. I don't know if that changes things or not. That's not my area of specialty. And maybe there's somebody on the call here that has a little bit more experience in that space. But I would just say to be safe, just run it by a securities attorney just to make sure. Because listen, the securities, they're not out there. They're not going to come knocking on your door. They're not out there investigating everything until crap hits the fan and complaints and stuff are starting to be filed. Now they're going to start digging. Now you're going to start getting audited and they're going to look into your business plan and structure. So that's why I'm saying a lot of people might be doing things that are non-compliant with the SEC and don't even realize it just because it's how they were taught. There's never been issues. It's how this person did it. I don't know, right? But again, that's why I would just suggest in any situation that you're taking somebody else's money and their return is based on your efforts and they're not actively involved, I would consult with a securities attorney. Great question.
Hey, Dallin, it's Al. Quick question. I was doing some reading on cap rates and it said that generally speaking, the higher the cap rate is an indicator that the investment is riskier and vice versa. Didn't quite connect that. Can you explain that?
Okay, I'm trying to think how to do this in a... So the cap rate is tied to what the market will essentially pay for that property. So if you look at let's just say it's a good 1980s build property. It's only 30, 40 years old. Let's say that's trading or selling at a 5% cap rate. You go down the street and there's a similar size property. Let's say they're both 100 units. You go down the street, this is something built in the 1960s. It's not renovated. Would you expect that one to be selling for less or more per unit than the one built in 1980?
Less, right?
Less. So the cap rate, remember I said there's a inverse correlation, right? When cap rates go up, prices go down. So if that one's selling for less, that means the cap rate's going to be higher, which may indicate that there's a lot more work to be done on that property. It might be older, it might have more rundown units, you might need to put more money into it to get it to where it needs to be.
Okay, so that's why it's considered riskier, because there
That-
might be a
that's-
lot of hidden costs that aren't apparent, that are ahead of
yes.
you. Okay,
Yes,
Okay,
it could
that
be.
makes
So
sense.
if that cap rate's higher, then you've got to start wondering like, okay, why? And for example, you look at a property in Phoenix and then you go to a tertiary market outside of Phoenix, your cap rate's going to be higher in that tertiary market because maybe there's not as many jobs or there's different economics in that area. So again, the higher the cap rate doesn't always necessarily mean that there's more risk associated with it. It might just mean that there's more work or there's not as much opportunity as if you were in a major city. Great question, Al.
Great, thank you.
Hey, Dallin, I got a question. Hope you can hear me or not.
Hey, Clint, glad you could join us.
Yeah, sorry I was late. I got a question. You mentioned, I saw that news about the property in Texas where they handed that back. That was foreclosed on. What's the process from there? Like, because there's a lot of these projects that have been underwritten, probably, that aren't going to make sense, currently, or if they flatten out even. Like, so what would be the process for that property in Texas or any other one that might be at risk from that point on?
Process of acquiring it, like if you wanted to acquire it right now.
Yeah, so like one thing we were looking at was who holds those loans, and we found out that actually a lot of the brokers end up being the ones that are holding the loans on some of this. That's what it seems to be anyway. And then do they just remarket it with them being the owners as a broker, trying to facilitate that, appreciate the cost as much as possible, or how does that work? Do you know?
I wish I had a response for you, Clint. We haven't ever dealt with foreclosed properties or looked into them. All the deals we've done have been market rate properties. So I don't know. I don't know that process. But definitely a great question and something that it might be, that might be a good webinar topic to do now that I think about it, because if there's going to be opportunities like that coming up, I think having a more general knowledge. So we could probably get a lender on to talk about what that process might look like, just so people are a little bit more educated. So I think that would be beneficial. What do you think?
I love it. Yeah, for sure.
In fact, I think next week, Hillary, is next week our debt and equity webinar?
Next week, we are not having.
Oh,
a
we're
webinar.
in our training. We're in our training. So 2 weeks, Clint, per our schedule, that in 2 weeks, our webinar is actually on debt and equity. And we were going to talk about some current rates, plans, things to look out for if you're purchasing multifamily. And we were going to invite in a commercial lender to talk about that. So I think that would be a good time too, to bring up that question again.
Yeah.
On, hey, say a property is foreclosing, what would that process look like if we wanted to get our hands on it? So either them or a broker would be able to answer that, which we bring both on at different points in the webinar. So great question.
Thank you.
So how did these properties get upside down in the first place? Did they not secure their financing on an ongoing basis and it was just floating?
Yeah. So what it sounds like with those deals back, that it was a floating rate. Some of them may have capped their rate. So they purchase a rate lock. It's basically insurance. So the interest rate won't increase over a certain amount, because then you can project out what the property is going to do. So even if they did that 3 years ago, nobody expected the rate hikes that we've experienced this past year. So they may have projected, say they got into that loan, we'll say 4%. They may have projected, hey, in 3 years, that loan's going to expire. But given our underwriting and what the market's been doing, we'll project that we'll refinance at 6%. And then it comes time to refinance and interest rates are 8, 9%. And so they don't have the capital reserves there to be able to refinance. And
Yep,
so they either
I
have to
agree.
short sale it and get rid of it, or they just stop making payments and they foreclose on it. So that's why I was saying, like, the way properties are being bought right now is so important. And short-term debt, like, if you can get into a property with fixed debt when I say fixed debt, interest rate for 5, 7, 10 years, that would probably be the best option to go right now. Now, sometimes some properties don't qualify for that fixed debt. So you still have to use shorter term debt, but is that operator purchasing a rate lock? And if they are, do they have enough reserves set aside to be able to refinance out of that if interest rates were to increase? So those are things
Right.
you just really want to be looking into. So honestly, Beck, poor planning, and people were getting greedy 2 to 3 years ago, and they were over leveraging. I think those properties, if I recall, I want to say they were like 85% leveraged. So there's a lot of debt on those properties. So right now, lenders, you might get 50%.
80% leveraged at very low interest rates, and interest
Right.
rates. Yeah, that's a recipe for disaster right there.
It is. And unfortunately, a lot of times that was the only way to get those deals done 2 or 3 years ago. You had to leverage as much as you could because of the low interest rates and because of the price. Like it was a bad time to be buying if you were too aggressive. Now there's people that some of the operators we're connecting with have been structuring their loans in similar ways, but they were well capitalized. They've never performed a capital call. So they never went back to their investors and say, oh, shoot, we need more money. Otherwise, we're going to lose the property. That can happen in these types of deals. The operators we partner with haven't done that. They don't have a history of it. So those are things that we look for in regards to that.
Can I throw something else on top of
Yeah.
that too, Dylan? So some of these operators out there as well, they were experiencing the gravy train, right? And they're jumping into these deals, and they're not renovating, they're not forcing appreciation. They were riding the appreciation wave and thinking that it was going to save them. Well, that wave crashed against the rocks, right? And if operators weren't doing what they needed to be doing, which was renovating units, increasing, rents, and forcing the appreciation in the property when it comes to refinance and out of that, bridge debt into a longer term loan, they can't. There's a gap there. And if they're not well capitalized, as Dallin said, they can't make up the difference. And that's where the shortfall is happening. So there are operators out there that were just, whether it's inexperience or over leverage, we're going to see a few more of these, I think, coming here in the next 12 to 24 months, where people are just going to be stuck. So,
and again, like we're still going after multifamily properties. We haven't turned away from them because we still believe that they are one of the best real estate investments to grow and preserve wealth. It's just, how are they structured, and how are the operators structuring it? How are they structuring the loan? What is their rent growth like? What is their reversion cap rate like? If you don't know this stuff, that's how you're going to lose money. Now, nobody has a crystal ball, right? Nobody could expect these interest rates rising, but let's be honest, like 2 or 3 years ago, we all knew what was happening, and we all knew that it wasn't going to be able to sustain, and that something was going to have to change. Like, I don't care who you are, even though we didn't know what it was going to look like, it wasn't sustainable. So some people just got too aggressive. They got too excited. They liked winning the deals, and it's not about winning the deals. It's about growing and preserving your partner's wealth as a team. That's really what it comes down to. And that's really what we focus on. That's why we do these webinars, so people can hear what's happening and also have a little more sophistication and education going in, so they know what questions to ask and be able to do appropriate due diligence. Because you'd be surprised how often this doesn't happen, and it's unfortunate. So great questions. Appreciate that. We got time for one more, if there's one more out there. Oh, and Lacey, thank you. I don't know if you guys saw in the chat box, Lacey provided some information on that property. So their loan had risen from 3.4% to around 8%. So whether they bought a rate cap or not, they probably didn't. So for example, what I mean by a rate lock, we closed on a deal in December and we purchased, I think the interest rate at the time of purchase was about 4%. And our team collectively paid over $1 million to make sure that that interest rate wouldn't go over 4.6%. So we purchased that insurance so something like this wouldn't happen, so that we could ride through whatever's going to happen these next few years. Those are the things that you want to be looking for. So. Excellent. All right, folks. Well, again, appreciate your time. We saw some new faces today, so this was great. If this was beneficial to you, invite your friends out, invite the people out that are close to you, that maybe they're partners that want to get involved as well. But we do these just about every single week. Next week, we won't be here. We've got a training as a team that we're going to be in all day Thursday and Friday. But this is it. If you do have interest in connecting with us more, then reach out. You can send me an email, Dallin@revequitygroup.com. You can go to our website, investwithrev.com. And first and foremost, let's just jump on a call. Like if you're interested in getting involved and getting to know us more and seeing what we're doing, let's jump on a call, because if the alignment's not there, if your goals are different than ours, then we shouldn't work together, but we can at least point you in the right direction, or maybe connect you with someone else that can help, because a big part of what we do is networking and education. So happy to help any way we can. Again, thank you for taking your time out of your day this morning to join us, and we look forward to seeing you on future webinars. Appreciate it.
Thanks, Dallin.